welcome to Markets and Mandate. And it's that time of the, it's that time when everybody would be really talking about the election, market expectations from the election, what is in the price, what is not in the price, and how should you really approach this event. Unlike last time, market expectations are that there would be continuity and this may not be a binary event. If that is the case, then what explains the sudden spike in volatility and why exactly are foreign institutional investors selling? Should you raise cash or it's time to just sit tight and just ignore the importance of event in terms of the overall portfolio strategy? Let's take that conversation forward with Hiren Ved of Alchemy. So nice to have you back.
Thank you, Nikunj.
Everybody's talking about elections and the impact of that on the market. What is your sense?
We're a democratic country, as they say, noisy, so we should celebrate elections, and naturally everybody is talking about politics and elections. But I mean, history has shown that it really hasn't mattered much beyond maybe a couple of weeks or months of volatility. Classic example was 2004. A lot of people are now trying to, at least a few of the naysayers say that is it going to be a 2004 India shining moment? We were all bullish on India and then suddenly BJP lost, Atal Bihari Vajpayee lost in 2004. And I tell people that the bull market that started from 2002-03 up until 2007-08, didn't really reverse just because the BJP lost in 2004. Because India's, you have to understand that India's bull market is not because of A, B or C. It's based on very fundamental structural factors. Yes, you can accelerate a trend, but very difficult to reverse a trend.
So you will not do anything in your portfolio because there is an election cycle?
Yeah, like buying FMCG stocks.
Yeah, I mean, sitting in cash, buying FMCG, maybe having a defensive tilt.
No, I think, I think trying to make event-based decision based on long-term investing is not something that makes sense to us, right? So I think we are sitting put. I think our positioning is very clear. And we are doing none of these like raising cash or trying to change the composition of the portfolio. No, we are not doing any of those things.
Some would argue and say that the near-term volatility is something which could be challenging. Now, given how markets are, where levels are, if markets do not like what the election mandate is, the swing could be 10 to 15%.
Yeah.
So, do you think you would be able to digest it?
Look, I think, one should never say no, what can happen, right? I mean, anything can happen. As I said, 2004, everybody expected something would happen. Or even before that, after that in 2009, when everybody thought there would be, Congress would not get, and then 2009, they got a good number of seats and the index was up 20%, circuit, the Nifty. So you never know what can happen. I think, yes, today it is fair to say that the market believes that there will be continuity. So if something goes wrong with that hypothesis, will you get a deep correction? I think you will, right? But we've seen historically that if the underlying stocks that you own have fundamentals, they have earnings behind it, they have cash flows behind it, value will come back. Same thing happened in COVID, right? I mean, nobody knew what COVID was. Nobody expected something like a lockdown could happen where everything would be shut down. And markets fell aggressively, but they came back.
If markets like the verdict, then are we in for a post-election rally?
Now that we've had a little bit of a nervousness, right? I'm actually happy because, some level of nervousness, some trepidation is important. That elongates the bull market, right? Because if you have a one-way run, nobody is afraid, there is no fear, you tend to discount too many things too fast. So my sense is that, you could have, the general trend is upwards. And I think as long as earnings keep growing, which they have been at a very stupendous rate, I don't see an issue.
Okay. Let's talk about what's been your portfolio strategy. You've been buying into energy, you've been buying into manufacturing, you've been buying into infra. That is a conversation we had at the beginning of the year.
Yes.
Have you changed anything after that?
No, Nikunj, because as you remember what we said when we last met was that I do believe that sector leadership has changed post-COVID. And there is always a recency bias that we have. We tend to stick to companies and sectors which have done well in the previous cycle. And the so-called previous cycle belonged to everything which was B2C, consumers, B2C lenders, right? I think there is a regime change. And whether you like it or not, the market's telling you very clearly, because where the outperformance is, and it's not a one-year outperformance. If you take the last 3-4 years, the best performing indexes have been real estate, the PSU banks, the defense stocks, capital goods, infrastructure, all of the so-called cyclicals, right? I think very clearly there is a leadership change. And I don't see that leadership changing so quickly because these cycles typically tend to last 6, 8, 10 years. You never know how long this cycle will start. But I'm very clear that we are at the early stages of this cycle. So we haven't changed our focus away from any of these sectors, right? I'll give you an example. In the previous cycle from the lows, the cap goods index was up some 14x.
How much is it up now?
It's now up 4 or 5x.
It has a long way to go.
Yeah, I mean, if I were to say that the previous cycle, and who knows if this cycle will elongate much longer, right? Because if we have to get to 10 trillion, you can't do it just on consumption. At some point in time, we have to build physical infrastructure in this country. And just because the political outcome is different, does it mean that geopolitical supply chains are going to change for your country? That's not going to happen. Does it mean that because elections in India change, suddenly everybody will buy from China? That's not going to happen. So some of these trends are irreversible. And therefore our focus on manufacturing, real estate. I mean, we've been very bullish on real estate as well. As you know, there were no real estate companies in the early 2000s that were listed. They all got listed in the later,
DLF,
And then at the peak of that cycle in 2008, the total market cap of real estate was about 7% of the total market cap. From 7%, we went down to 0.6% just pre-COVID. And from 0.6, we've just gone up to 1.8, 1.9. I mean, if we are going to talk about a 10 trillion economy, don't you think real estate companies will have some market cap?
So buy all India players, buy regional players, what should one do?
No, just buy strong players, right? I mean, you could buy an all India. See, real estate by and large has been a local industry. There have been few players like Godrej, etc., who have been all India.
Godrej, DLF, Macrotech, 3.
3 large ones, and then you have the few ones which are focused in the south. But now I think everybody is getting everywhere, right? Because what happened was that the industry got massively consolidated. So the number of players in each geography really shrunk. Now one guy can't capture all opportunities, and therefore a Prestige has now come to Bombay, for example. They're going to Delhi. DLF has come to Bombay, right? So I think the strong players who have a balance sheet, and unlike the last cycle where they were massively leveraged, there was no organized capital available to them. So they were borrowing from NBFCs and they were borrowing from very high cost sources. Today you have the BlackRocks and the GICs of the world, sovereign capital which is available, high quality institutional capital that is available to the real estate industry. And we have RERA, so there's far more regulation, balance sheets are deleveraged, and demand is pretty strong.
They say real estate follows a cycle, 6 to 7 years. And we're already 3-4 years in that cycle, which means that you pretty much have seen best of the gains.
So Nikunj, what happened during COVID was that supply was completely constrained, right? Because you couldn't build. There were no workers, everything was shut down. So all that inventory, and unlike the previous cycle where you could sell on a plan, right, on a piece of paper, today the users want to go to a good developer and they want to buy ready inventory, right? They don't want to buy something on a plan that you show. So my sense is that in this cycle, the previous cycle was also dominated by speculators and investors because there was phenomenal price growth and appreciation that was happening. Now developers are very clear. They are not sitting on land banks to make inventory gains. They are building and they are selling. They are building and they are selling, right?
So what do you own in real estate?
We own all of them. We own the big guys. We own Prestige. We own Sobha.
And you think this could be a portfolio bet for a couple of years?
I think so. I think so. I don't want to preempt the cycle so early into the game. See, another thing is very instructive, Nikunj, is that if you see the kind of wealth creation that has happened in this country, if you take the number of companies which were in the 500 crore to 5,000 crore bracket or 10,000 crore bracket 5 years ago versus what has happened to the market caps of those companies, right? If a promoter would own 40-50% of a company which had 1,000 crore market cap, he would be worth 400-500 crores. Today, if that same company has a 5 to 10,000 crore market cap, he's worth 4,000 crores. What do you think the first thing he's going to do when he becomes wealthy? He's going to buy a bigger house.
You bought a big house already?
No, I'm still staying in my own house, right? But what I'm trying to say is that, this is the best discretionary consumption play you can have in this country. Because once people become wealthy, right, it doesn't matter whether you are buying 30 crores or 40 crores. But for a guy who's buying a 30 lakh flat, a 40 lakh flat matters because that incremental 10 lakhs on a base of 30 is a very significant amount. But once you move to a certain number, beyond a certain number, if you're willing to spend 10 crore for a flat, you can spend 12 crore. It's not going to make too much of a difference.
Tip of the iceberg kind of a bracket, like top of the pyramid, 1% of India, less than 1% of India. Rest of the India is still about, you bargain, you want something cheap, you want to wait for the big bazaar and the Flipkart sale. That's India for you. What you're saying is absolutely right, but that's like handful, isn't it?
Yeah, but the top 1% becomes the top 5%, which can today spend, right? That's great. Anything that is premiumizing.
What about, apart from real estate, what is where you say that, look, it's a buy and a hold, and it's a buy and a multi-year hold for me because I want to ride the cycle, I want to ride the momentum. It could be multi-year momentum. So real estate, fair. 7-8 year cycle, 3 years into it, if India continues to grow, more affordable housing, what is looking luxury will become affordable.
Yeah.
And what is looking super luxury will become luxury. That's how economy will progress. So fantastic point. What else is part of your buy, sell, ride the cycle portfolio?
The high quality capital goods companies.
Okay. What is high quality? Can you define that for us?
Yeah, I mean, companies which have technology, products, right? So let's say the varieties of ABB, Siemens, Hitachi Energy, GET&D. I mean, these are all companies which supply into several end sectors: power, renewables, railways. There is electrification happening everywhere, right? Data centers are being built. India is going to be power hungry country, right? If you're going to go, if everything is going to be electric, you will need power. And if you need power, if you're going to build so much of renewable capacity, you need to evacuate that power from Rajasthan and Gujarat, where all the solar and wind is happening, and then take it to the consumption centers, which means that you have to invest in the grids. You have to automate the grids, right? And therefore, I think that cycle which didn't play out, we had a lost decade between 2010 and 2020, where unfortunately we couldn't build out the infrastructure for various reasons. I think that is all coming back.
Again, fantastic point. This was all supposed to start in 2010. It is starting in 2022 or 23. So almost like a 8-10 year period where the cycles were supposed to go up because of the opportunity. For whatever reason, they did not go up. Banks ran into trouble. Private sector capex ran into trouble.
Yeah.
Power companies went belly up.
Yeah.
I mean, I remember using the word policy paralysis.
Yeah, I mean, that was, you see, so everything, I mean, like it all started in 2010, 2011, when the 2G scam broke out.
And then power.
Then there was the
and
coal
then-
scam, and then all of this landed up with the courts.
And then banks had to force.
And then Supreme Court kind of cancelled so many licenses, which spooked the private investors that, mera license hi chale gaya, right? Everything.
The spirit was broken.
The spirit was broken, and then the banks, all these assets became unoperational. So the banks were saddled with massive NPLs, and nobody was willing to lend to these sectors. Neither were the private guys willing to spend in these sectors. So that entire cycle was gone. We had a lost decade. And then it took us so much time through the IBC process. Some of these assets went from weak hands to strong hands. As you know, like Bhushan Steel, Tata Steel bought, some cement companies, Ultratech bought.
Airports were auctioned, everything had to
Ports
go
were
through
auctioned.
NCLT.
So initially all these non-operational assets went into stronger hands.
Understood.
Right? And now, post that, under investment over the last 10 years, we will have to start investing, right? Because you can't say that the country is progressing, but power consumption is not growing.
Fair point. Okay. So now let's look at the valuation part. A, the so-called specialized engineering companies are all MNCs.
Yes.
Siemens, ABB, Hitachi. And B, none of the MNC company is trading at a P multiple which is less than 50 times, even 1.5 year forward. So for an investor who's say, okay, I love the show, I want to associate with Hiren's thought, but if I'm buying stocks at P multiple of 50, will I really make money?
So Nikunj, again, without getting into specific companies, right? See, the thing with capital goods is that even when, let's say 3 years ago, when let's say ABB was trading, I'm just giving a hypothetical example, at 2,000 rupees, right? The PE was high, right? So what happens is that typically in these companies, because the base was so low, let's say hypothetically, I'm saying any company, let's say where the profits were 100 crores. 10 years ago also the profits were 100 crores. But in these kind of companies, profits don't go from 100 to 120. In that cycle, profits go from 100 to 1,000 over
Because
a cycle.
operating leverage and financial leverage.
Yeah,
kicks in.
because the scale changes, right? See, unlike an FMCG company, you will never find profits going from 100 to 200 crores in 1 year. But in cap good companies, in engineering companies, you've seen 100% growth in profits or 50% growth in profits, right? So the lead indicator in those businesses are order books. Stock prices move on order books. The execution and the revenue and the profitability is a lagging indicator.
Understood.
Right? The leading indicator is order books, and order books have grown in all these companies, right? And I am not suggesting to any of your viewers that you buy A, B or C, right? But this valuation argument was relevant even 3-4 years ago when the cycle started for these companies. But if you look at the way profitability has bounced back, what do you call cyclical? Cyclical में profit 100 से 120, 120 से 140, 140 से 180 नहीं
It is not
जाता है।
FMCG.
वो 100 से 200 जाता है, 200 से फिर 350 जाता है, 300 से 400 जाता है, और जब साइकिल रिवर्स होता है तो रिवर्स भी वैसे ही होता है।
400 का 40 होता है.
हाँ।
Okay. So the cycle looks good to you, which is important.
Yes.
Okay. Now let's look at something which is non-consensus view, and I'll keep it open. If I say buy EMI stocks, energy, manufacturing, and infrastructure, they are like the consensus view right now. Nothing wrong with being consensus, but large part of gains are made when you buy something which is cheap and where earnings they catch up, where you get a benefit of E and P. Anything on your radar where you think that it is a slightly non-consensus view but could become big?
So first of all, I want to tell you, while a lot of people may be talking about EMI, there's a nice acronym that you put in. You should see how many portfolios have overweight on EMI.
Oh, is it? I mean, I've
You'll
not
be
analyzed.
surprised.
I've not analyzed it, so.
You should analyze that, right? So people talk, but I think there is, positioning है नहीं उतना जितना लोग बात कर.
So what is the positioning? Still with private banks, still with
Yeah,
IT?
you look at portfolios. I mean, and again, like, this is an open market. Everybody has a
35%
view.
is still financial with
Everybody
everybody.
has a view, and everybody should express their views. So first of all, I think that my view is that while there is a lot of talk, there is always talk about companies that do well or sectors that do well. चर्चा सबकी होती है, लेकिन ownership है नहीं जितना होना चाहिए. Point number one.
Great.
Having said that, to your point that if this is consensus, what is non-consensus where I can make money? So I think, for example, chemical is a sector which has not done well post 2021, right? Because I think they had unusually great time post COVID. Prices went up, and now there is deflation, inventory drawdown, demand is not that great. So maybe they are in the process of bottoming out.
For a change, we've not been stock specific, so but we'll still refer to the disclosure. Whatever we've used for reference purpose, whether it's ABB or whether it is some
all the names,
stocks.
all the real estate names, we own it in our client PMSs. So
And there's a
people
vested
should not
interest.
take this as an advice and
And
do
you will
their own
make-
research.
And you will make money if they go up. That is a disclosure which we need to, put it out. When you
Yeah.
say vested interest, look, if they go up, his portfolio scheme will make money. Second, the sum and summary of today's discussion, since the turning point right now is election, your view is that election, if markets don't like the verdict, it could be a 10 to 15% swing event, but that will not change your portfolio strategy. History has told us that in the short term, sentiment will have an overarching theme if markets don't like the verdict, but the process of reform in India is irreversible.
Yes.
Okay. Second, EMI, whether it's energy, manufacturing, or infrastructure, that's the theme which should be heart of everyone's portfolio. And whether we discuss it, but in terms of positioning, portfolios don't have it.
Yeah.
And third and most important is in terms of in contra bet, it could be chemicals, it really could be agri. These are themes which could be good hunting ground.
Yes.
Anything which we missed?
No, I think it's always interesting. So new things keep happening. But I think I think we are onto something good over the next couple of years. There can always be bumps on the road, but we have been of the firm belief that we are in a 2003, 2008 kind of cycle in terms of sector leadership, with couple of new sectors thrown in, because in every cycle there is something new. And I think that let's hope that everything turns out well over the next month or so. We have the continuity that everybody wishes for, and hopefully we'll see good times.
Well, good times there. Thank you very much. And that's it on this edition of Markets and Mandate.